tuning in. Today we are broadcasting live, so if you have any questions, just pose it live. I will get back to them as soon as possible. If you manage, I will open the comment section below the video for latecomers right after after the transmission below. You will find out, and also I'll get back to them. Thank you very much for tuning in once again, and without any further ado, let's get straight into episode. Okay, and let's get, no, not from trade idea. I need to switch back to economy view, and we are starting up with whether it's higher odds for Fed to break something eventually. So for decades, interest rates have fallen steadily, and that was due to slower GDP and employment growth. Right now, in 2022, after consecutive rate, after consecutive strike of hiking interest rates, our real interest rates remain still near historic lows. So that's the problem, and TNXs also have fallen negative in 2021. Right now, hovering real interest rates, 10x real interest rates hover around 1.70%, 17%. This causes many sleepless nights for governors as well as investors. But we are all not all lost yet. Unemployment rate is below historical averages. To have 263,000 jobs added even after policy rates have been raised by some around 350 basis points is definitely no joke. Recent months we were about giving up to job openings for every unemployed person. So that's very good. What's also lifeline for the economy is the business that have pricing power. That's the businesses that will likely be more resilient to maintain borrowing capacity and healthier margins. By pricing power, I mean a company that has ability to raise prices without reducing demand in their products. So this pricing power will remain intact until there are no economic disruptions breaking sentiment lower among customers. So remember, interest rates hike given the market more expensive, given the environment for the market, for the companies, um, more expensive corporate debt as lending conditions become more constricted. Market right now, however, is in up mode, and that's happening that remaining during recent weeks, albeit we have investors' optimism waning among this hot labor market right now, bringing some opportunities for Fed to pivot. So the market might be overdone. Fed is nowhere near from stopping, like it or not. What's in the recent jobs market to convince them not to take policy rates above 5%? Is the question. Fed is aiming at demand distraction as that's the one of the key component of inflationary stimulating factor. So that's for this one. Market outlook. Let's jump to another one. Sorry for me, my voice still haven't recovered yet, but I make my best to deliver this content to you. The question is, should you sell everything before 2023 unemployment shock? So Bank of America found that Wall Street's consensus equity allocation model that they are following throughout recent years shows that it's a very reliable contrary indicator. That is, it paid for them to be bullish when Wall Street suggested underweighting equities and vice versa. Virtually, when Wall Street's equities allocation is below 52%, that is for them an indication to buy, and where it's about 58 or more, that's the opportunity to sell. Right now, we are in a period where maybe I'll show you out. PCCE, that's a very interesting chart of ratio of put call among equities on CBOE. So we find out what's the sentiment. This month, during its bear rally, we haven't had this spike to the puts. So more and more investors stopped to hedging their positions. That's why that's still an opportunity to slow down forward. It's still very early of December. That's why I wouldn't right now bet that this slide may happen this week or another, but this week, even if taking into account that December is more often than not a bullish month, right now this is bear year. That's why the conditions may act in reverse. So I would be very cautious in terms of right now buying equities, but you may await the risk for yourself. So Bank of America isn't alone. If we just Bank of America isn't alone one with its negative stance on stock. Market strategy teams, JP Morgan as well as Goldman Sachs, have also warned of further declines early next year. That is everything. I mean, the specter of an economic recession. Does it mean you need to sell all of your positions right now? So my stance is not. If you are carrying positions right now, you may just consider cutting some. Ignore that doom and gloom projections, as there are no real visible black swans on the horizon, and various positioning is right now keeping in favor of bulls as I bears as I mentioned, but also the bulls are somewhat a very important power right now on the markets. So that's out of this section right now. Crypto outlook. I didn't have prepare any of the slides for you, as there is a case with Sam Bankman-Fried. The main topic for me, it's still falters around with whether should he go to the prison or not. In my opinion, as he cheated many people, many investors, he would rather go to jail than not. But I will get you informed during next episodes. Market mover section. And that's also not out of importance. So let's jump into our beautiful economic calendar. On Monday, we had PMIs. Just look at this. It's giving the power to Powell to hike interest rates even more. We had PMIs at 56, so we are expanding again after this very poorly published October's rating. Right now, we are backward with expansion period. That's why it's giving the power to bears, because the good news for the market is the bad one for the stock market. The good news for the economy is the bad one for the stock market. If I haven't put it enough clear, Um, so right now PMIs are somewhat shaking the market. Just look at target rate probability for Fed meeting. Right now, 75% of market participants are betting for 0.5, not 0.75, but the jaws are not over yet. On Tuesday, however, we have IVPMI out of the Canada and also GDP growth rate out of Australia. In terms of Australia, yeah, just look at this projection of forecast. There is a 6.4% of an expansion for Q3 expected for Australia. But even if it get worse, Australia's share of global GDP in 2021 was just below 1%. That's why this gauge shouldn't shake the world MSCI index to large extent. On Wednesday, we have very interesting data that is unit labor costs out of the US, and we have for the Thursday initiative claims that, as we know, the Fed is looking at the most. Friday, PPI's US, core PPI US, Michigan consumer sentiment. These are the most interesting events that you should take care if you are a short or medium term trader. So that's it. Let's have a look quickly at next. What we got next? Oh yeah, of course, we have trade idea. So in terms of trade idea, just have a look. That's a very interesting, in my view, option for you. That's the index you might not know, but that's very interesting. Once again, WIG20, it's a Polish index of most important Polish stocks. Right now, we are after this very difficult time for the Polish stocks, as there were almost 20% inflation in Poland, as well as military warfare between the neighbors of Ukraine, whereas during this war between Ukraine and Russia, this supply chain distortions got even worse. Also, there's energetic crisis upon the way, and right now we have gotten so cheap on the index that we had a bullish power on the market that took around 29% of growth. Right now, the market expects this impulse to continue with this pennant being formed, but that's a trick. Just look at this one. WAG20 right now have tested this continuation pattern of triangle, ascending triangle, more than 3 times each way. That means this pattern starting being negated. So with accordance to technical analysis, when the triangle with an approach to an apex boundary is tested more than 3 times at each side, that's normally an indicator of negation of this continuation pattern. So right now we have some struggle with getting through this 1760-ish area. We have broken down in the market structure once. We tried to recover, but to no avail. So for me, it's an obvious point that we start selling off right from here. So European indexes are at high levels right now, and that might be the time for those indexes to correct, to go through correction phase. And I do expect that the objective for this formation would be right around those levels of 1630s, as this is a normal objective for such pattern failure. So, if you wanted to check out with me what's the um, risk reward ratio for this trade, I would put right here my stop loss, and that's a risk reward ratio at around 3.0. That's still decent. So, you might lose the most around 1.6, 1.8, 1.8% for 5.7% gain. So bear in mind that WAG20 is not very liquid index. That's why you should adjust your position accordingly. Also remember about stop losses, about alarms, alerts, whatever you call it, and about managing your risk and not putting everything on the table. Just risk the amount of money you may afford to lose. So that's it in today's episode. Thank you very much for watching, and see you tomorrow at 8:45 East time.